Welcome to TheoTrade. This is Don Kaufman, May 6th, 2020, and you are watching the TheoTrade evening video. About 3 minutes left inside of the trading day with the SPOOs down some 15 handles. We're back, baby! Back to what? Right to 2842, which is effectively one of our gravity points. So, hey, we are still pinging back and forth between gravity points. Most of today's trading session, quite frankly, has just come down to like the last half an hour of trade. We saw some sell side activity as, weakness is starting to finally overwhelm the broader marketplace. Listen, the entire trading session, as I said, kind of came down to the last half hour, but we've got really a bifurcated marketplace. Well, it starts with the financials. The financials starting to feel some real sell-side activity, and I'm starting to question this. Are they about to make another leg lower? Meanwhile, as the financials are weakening, it's all about technology continuing to bid a little bit higher. I mean, what we're actually seeing inside of the marketplace, and I think that an intraday chart will really kind of exemplify this, and I'll kind of detail this for a moment. So we've actually got the financials weakening throughout the course of the trading session. As the financials are coming off, you've had tech wildly strong throughout the majority of the trading day. What that effectively did is it took the S&Ps right through the middle. So for instance, this is SPY. These are our financials, which are XLF. Okay, and down below, this is just tech, and specifically we're actually talking kind of about the monsters of tech. If you look at the monsters of tech, they're carrying everything. So what you got is financials weaken, tech gets strong, the S&Ps slide right through the middle until ultimately the last half an hour of the day where everything starts to pull down a little bit. Tech actually weakened a bit, and that's actually due to what we call statistical arbitrage that actually kicked in late in the trading session, and we pull back down to, well, the 2842 gravity point, which I'll come back to in just a minute. But there's one really, really key point, okay, that needs to be discerned out of this. When I talk about tech, I am not talking, people, about the Nasdaq, because if you start looking at the NQ, and the NQ, all right, it slipped a little bit here, but hey, listen, bottom line, on a percentage basis, we start looking at this stuff on a percentage basis, right there is your Nasdaq, which is up, what, 0.62. It's all about the monsters of tech. I mean, this entire marketplace, you just have to ask, how long can tech just hold this entire marketplace together? And when I'm talking about tech, we're talking about, again, the monsters of tech. Now, the monsters of tech, that's it's kind of my phrase. And it's my phrase in the marketplace simply because, well, I wouldn't say coined per se the monsters of tech, but I built like a conglomerate symbol. And what this symbol basically does is it takes a ratio of Facebook and Apple and Microsoft and Google and Amazon and puts it together. And it really, truly is. It's about 5 stocks. But if you look at those 5 stocks, the market cap of those 5 stocks, okay, are massive in comparison to, well, the rest of the marketplace. The only thing that can offset the monsters of tech is none other than the financials. But the financials are losing 2%, okay, to actually cause the S&Ps to slide a little bit. In addition to that, are there other sectors that are weak? Yeah, you better believe it, okay? You've actually got tech that's relatively weak, but you're also seeing some broad weakness inside of none other than the energy sector, which is down about 2.6%. So, yeah, no doubt, it's a party out there, people. Again, big. There's the closing bell. Big bifurcations inside of the overall marketplace. Let's go back to the S&Ps for just a moment, because the S&Ps are effectively closing, again, on their lows of the trading session. So I wanted to zoom out for a second into the S&Ps, and I'm going to go ahead and close up this left side bar. They're the gravity points, and I've labeled the gravity points. You start looking at them, on a bit of a longer time frame here, and it's it's a little bit messy. Nevertheless, where are we at right now? 2842. What do we have down below? 2811. And if we actually did break through 2811, that is an express train all the way down to 2731. So it can get wild and woolly out there, and wild and woolly in a hurry. Nevertheless, again, at the last couple of seconds of trade today, we did see an extension a bit lower in here. All right. The reason I wanted to bring up the S&Ps and the reason I wanted to show you all of the gravity points is what's even more important than that. Let's take a look at the 30-day 1 hour. We have a incredibly, and this is exactly what I was talking about on Monday night's video, an incredibly tight range, okay, inside of the S&Ps. Now, that range has been rather persistent. How persistent? Okay, and we actually jumped into this range. I guess we could call it here, April 8th. We're still in this range right now. Where are we? May 6th. What do you got? An entire month inside an incredibly tight range. Now, range trading doesn't necessarily bother me. But the problem you got over here is you have a really high, VIX. You have a high VVIX. You have a high, vol future. Effectively, we're inside of a bit of a volatility box. Now, you get inside of a volatility box, again, when you have all of these parameters, and they are up there, people. I mean, the VVIX is still rocking way north, just way north of the 110 level. The volatility futures are still inverted. The VIX is in the last month, between what, 45, came down to like the mid-30s over here, so we're rocking. So instead of actually calling this range bound, I call it a volatility box. In a volatility box, if we pop outside of it, it's going to get ugly. It's going to get really ugly. Okay, a couple of things that you can do. It doesn't necessarily discern that we're going to break out of this lower or higher. So one of the things I've done, once again, I'll reiterate, I've gone out and I've actually bought, yes, purchased iron condors. I purchased iron condors just in case out there because I need a little bit of a hedge, all right, if we start to break outside of the volatility box. Now, the next thing I've actually looked at, technology, okay? Why am I looking so detailed at tech? As I said a moment ago, how long can tech really hold us together? Now, I can't tell you, how this volatility box is going to end, but I can tell you one thing very definitively, and that's this. If, this market is to descend, and if this market is going to go lower, it will be on the back of technology. And therefore, I'm actually taking some risk in tech right now. What am I doing in there? And I've talked about this quite extensively. I'm creating negative delta. Negative delta is bearish positions, and I've got them on inside of Microsoft. I actually just put an in-out spread on, a bearish in-out spread on Apple. And I've actually got some bearish positions inside of none other than Facebook. I've also got Intel, which is just off the bottom of your screen over here. So I am starting to stack a couple of bearish positions in technology. Okay? Why? Well, because I'm positioning effectively for, a lower marketplace. Because again, if you start comparing and contrasting some of the major products out there, and in this case, we're actually going to cruise over to the XLF, and you look at the XLF on a year-to-date percentage, right? On a year-to-date percentage, you've got the financials. Hey, they're already down 31%. Going to get worse? Absolutely. You just saw them sell off today by the tune of about 2%. All right, so you get it, right? Financials are being beaten up. Then we cruise over to the energy sector. The energy sector is off by some 40%. Can it continue down? Now, this thing almost looks like it's going to make a leg lower too, and it's down 2.6%, percent today. And we can go on and on through different sectors, but these are the sectors that really matter. So you look at this just beaten down sectors, and if I'm talking about beaten down sectors, I just have to throw the IWM in here because this is, in the small caps, it's the worst performer of the major index products, and it's down some 24-25%. Okay, so if you're going to make a leg lower in this marketplace, what do you got? What's holding us together in here? It's the monsters of tech. The things are up 8% on a year-to-date basis. And why am I so adamant about, that tech would have to sell off? Because to make a leg lower, if there's going to be sell-side activity in the marketplace, all right, what do you think some of the mutual funds hold? And when there's going to be a redemption in a mutual fund, what do the mutual funds hold? They hold big tech stocks. So if there's going to be redemptions, eventually they're going to have to bleed out of a lot of these big tech stocks. I don't care how big their market caps happen to be. Big market caps, of course, are going to get hit first because the number one holding in everybody's portfolio is going to be a Microsoft. It's going to be an Apple. It's going to be a Facebook. It's going to be an Amazon. Intel is going to be up there as well. People, these are the number one holdings inside of funds. And as we start to actually liquidate portfolios, and if that's the direction we're heading, that's why I'm carrying some of these bearish positions inside of major tech stocks. Not because I see selling is imminent. You have to rationalize that if another down move is coming, you need to think about sector rotation. What's already been decimated and what hasn't been decimated. But selling doesn't always get specific. This is really going to impact the financials. It already has impacted the financials. Right? But you can't squeeze, blood from the turnip out there. It's already down some 30%. So what do you have to do? Again, redemptions in mutual funds. Mutual fund managers, they cannot discriminate. If you want some of your money back, They have to sell everything in that portfolio, and you start to look at redemptions inside of tech. Again, if you think this marketplace is going to sell off, and I'm not telling you how the volatility box is going to end, but if you think this marketplace is going to sell off, you're actually saying, I'm bearish in tech. And we're going to see how this one actually plays out in some of the days to come. One last key point that I want to make in this evening's video. They've come back to life. Well, I'm back. Okay. If you take a look at the bonds, there are signs of life in the bond market. The bonds, well, why? Okay. What's actually occurred inside of the bond market? The Treasury early this morning announced just a monstrosity of debt. In fact, they're even going to bring back the 20-year. It's coming back into style. They're going to be just selling more debt than anybody can even fathom on a week-to-week basis, and the marketplace may not be able to support it. So you actually saw the bonds selling off just a little bit. Okay. However, we're supposed to believe at this point that the Fed is actually going to be buying all of the debt from the Treasury Department. You have to love this. Except the amount of debt that is going to be offered by the Treasury, okay, is far greater than the entire balance sheet right now over at the Fed, meaning that there is going to be deficits like we never imagined. They're going to have trillions of dollars of debt. Again, they're bringing back 20-year in there. So the marketplace panicked a little bit and had some sell-side activity. What's interesting about this, though, is that the bonds sold off, okay, which brings interest rates a little bit higher. It's the first time in a long time we've actually even talked about rates. If you bring up the TNX, look at this. Rates pop just a little higher on the 10-year. The other thing that I keep pointing out is the volume has just been non-existent inside of the bond market. It upticked a little bit today inside of the 30-year, and it definitely upticked a little bit in the 10-year. As I said, interest rates went a little bit higher. Typically, interest rates higher kind of help the financials. It did not. Okay? It did not, because in a situation we're in right now, higher interest rates, now it's actually being met with the idea of default. So it's a little bit of a catch-22. I am telling you, in just the next 2 trading sessions. You got 2 trading sessions left in the week, this Thursday, this Friday. And those 2 trading sessions, okay, you want to keep watching the bonds because we have initial jobless claims, of course, coming out on Thursday. Then we have the employment report coming out on Friday. Okay. Also, a quick look. Where are we on the week? Absolutely nowhere. Decent size expected move. And what I am telling you, by looking at the expected move, well, you should expect a lot more movement as this week progresses into Thursday or Friday. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.